If you're self-employed and somebody has told you that you can't get a mortgage, you've been talking to the wrong loan officer, because there are 4 specific loan products in 2026 that were built for people exactly like you. Most banks will only tell you about one of them. By the end of this video, you're going to know which one fits your situation, exactly what documents you need for each one, and the one mistake most self-employed buyers make in the year before they apply that quietly costs them 60 grand of buying power. Hey, I'm Dustin Hutley, a loan officer for Envoy Mortgage. I work with self-employed buyers every single week, contractors, consultants, real estate agents, freelancers, 1099 sales reps, gig workers. And here's something most of my industry won't say out loud. Banks are not built for entrepreneurs. Here's the structural problem. Almost every underwriting guideline ever written was built around the W-2 employee. The system assumes you get paid the same amount on the same day every 2 weeks. So when you walk in with 5 1099s, 2 business bank accounts, a Schedule C with 20 grand in write-offs, and you tell a loan officer, I make 150,000 a year, the average bank doesn't actually know how to count any of that. So what most banks do is they default to the most conservative possible reading of your income. They average your last 2 years of tax returns, they subtract every write-off you took, and the number that comes out of the bottom line is usually something closer to what you actually earn. That's why so many self-employed buyers walk in making twice as much as the W-2 employee next door and get told that they qualify for half as much of a house. That's not because you can't qualify, it's because the bank doesn't have the right tool or the right product. Because the right tool is one of these 4 products, and most loan officers either don't know they exist, don't know how to use them, or don't get paid enough to bother walking you through which one fits. So let me walk you through all 4 right now, and these are just the main ones. Product number 1, conventional financing with 2 years income average. This is the loan product almost every bank will quote you, and despite the headache, it's still the right answer for a lot of self-employed borrowers, especially if your business is stable and you've been profitable for at least 2 consecutive years. Here's how the math actually works. The underwriter takes the net income from line 31 of your Schedule C. That's your business income after all expenses and write-offs. We add back certain items the IRS lets you deduct that don't actually leave your bank account, like depreciation. Then averages that adjusted number across the last 2 years of tax returns. The 2-year average becomes your qualifying income. The good news, this gets you the best interest rate for the 4 products I'm covering. The lowest down payment options, including 5% down conventional and 3.5% down FHA, and access to most loan programs, including down payment assistance. The bad news is, if you took big write-offs in either of those 2 years, your qualifying income is going to look smaller than your real income. And in some industries like real estate or trades, that gap can be enormous because you're doing the right thing. You're writing off a lot of taxes. That's your right. I had a self-employed real estate agent walk in last year. She made about 180,000 in actual gross commissions her last full year. But after her car expenses, her home office deduction, her marketing spend, and her health insurance, her Schedule C net was $67,000. The bank she went to first qualified her based on that $67,000, which meant they offered her a max purchase price of about $110,000 price point, below what she could actually afford to carry. That's the gap. Product number 2, bank statement loans. This is the product that exists for the exact situation I just described. Bank statement loans completely ignore your tax returns. Instead, the underwriter pulls 12 to 24 months of your business bank statements and calculates your qualifying income based on the deposits. They typically apply what's called an expense factor, usually somewhere between 25% and 50% depending on the industry, to account for your business costs. So if you deposited $200,000 in revenue last year and you're in a business with a 30% expense factor, your qualifying income is roughly $140,000, which is going to be a lot closer to your real economic picture than what the tax returns would show. Bank statement loans typically have higher interest rates than conventional loans, larger down payment requirements, usually starting at about 10% down, and they're not eligible for most down payment assistance programs. So you're paying a premium for the flexibility, but for a lot of self-employed buyers who write off heavily, that premium is worth it because you're qualifying for a $130,000 more house than you would with a conventional loan. I want to be specific about who this product is right for, because not every bank statement loan officer will be honest about this. Bank statement loans make sense if you have at least 2 years of consistent business activity, you have strong recent deposit history, and your tax returns understate your actual income because of legitimate write-offs. Bank statement loans don't make sense if your business is new, your deposits are inconsistent, or you can comfortably qualify on conventional. Don't pay the premium when you don't have to. Product number 3, profit and loss statement loans, or P&L loans. This is the cousin to the bank statement loan, and it's the product almost nobody talks about. Instead of bank statements, the lender uses a CPA-prepared profit and loss covering 12 to 24 months. The P&L documents your gross revenue, your operating expenses, and your net income, and the underwriter qualifies you on that net. Now, why does this exist when bank statement loans already exist? Because not every business has clean bank deposit history. If you run a cash-heavy business, your bank statements won't tell the full income story. A CPA-prepared P&L can't. P&L loans usually require a CPA to prepare the statement, not your bookkeeper. A licensed CPA who's willing to sign off, and the rates are typically similar to bank statement loans, meaning higher than conventional. But for the right borrower, usually a business owner with a CPA they already work with, this product can be the cleanest path towards qualification. Product number number 4, DSCR loans. Now this one's different from the first 3 because DSCR loans don't actually qualify you on your personal income at all. Now this is specifically for investment properties. So DSCR stands for debt service coverage ratio, and these loans qualify based on the income the property itself should generate. Here's how it works. If you're buying a rental property and the projected rent on that property is $3,000 a month and the total monthly mortgage payment, including taxes and insurance, is $2,500 a month, your DSCR is 1.2. That means the property's rental income covers 120% of its own debt service. Most DSCR lenders want to see a DSCR of at least 1, meaning the rent at minimum covers the mortgage payment. This is the product that's quietly fueled the explosion of small real estate investors in the last few years. Because if you're a self-employed borrower trying to grow from owning your primary residence to owning additional properties like rental properties, DSCR lets you scale without needing to gross more and more personal income to qualify for each one. DSCR loans are investment property only. You can't buy your primary residence with one. Down payment is usually between 20 to 25% on these particular products. Rates are higher than conventional, but for entrepreneurs who want to build a portfolio without their day-to-day income limiting how many properties they can hold, DSCR is the tool. And let me tell you about DSCR because it's very little documentation. So because we're not using your income to help you qualify, a DSCR loan is only looking at what an appraiser will deem as the going market rent for that particular property, and that's really all that's used to qualify other than verifying your assets for the down payment. Now let me make this real. Here's how I can actually walk a self-employed buyer through this decision when they sit down with me. Question number 1, are you buying a primary residence or an investment property? If it's an investment property and you want the property to qualify itself, then DSCR is a great way to go. End of conversation. If it's a primary residence, question number 2 is, how do your last 2 years of tax returns actually look? If your Schedule C net income is solid and supports the house you want to buy, conventional with 2-year averaging is your best move. Lowest rates, lowest down payment options, eligible for assistance programs. If your tax returns understate your real income because of legitimate write-offs, that's when we look at bank statement loans or P&L loans. Bank statement if your deposits are clean and consistent, P&L if your CPA can document a more accurate picture than your deposits can alone. And the only way to actually figure out which product fits is to look at your real numbers, your actual tax returns, your actual bank statements, your actual goals. This is no shortcut. Anyone who tells you which loan you need without looking at your documents is totally guessing. Now let me give you the $60,000 mistake I told you about at the beginning of this video. And therefore it won't be a mistake that you make at the closing table. It's a mistake you make 12 to 18 months earlier at tax time. Most self-employed people structure their taxes purely to minimize what they pay the IRS. Every write-off they can legally take, they take. And if your only financial goal is reducing this year's tax bill, that's the right strategy. But if you're planning to buy a home in the next 2 years, every dollar of write-off you take this year is going to reduce your qualifying income by anywhere between 60 to 100% of that dollar, which means a $10,000 write-off that saves you $2,500 at tax time can cost you $60 to $100,000 of buying power on the mortgage side. The fix is not to stop taking deductions. The fix is to plan 2 years out. If you know you want to buy a primary residence 12 to 24 months from now, the right move is to sit down with your CPA and your loan officer in the same conversation, look at the trade between tax savings and buying power, and structure your last 2 filed tax years to maximize what underwriters can actually use. That single conversation done before you file can be worth more to you than every credit score improvement video on YouTube combined. And that conversation never happens at most banks because the loan officer doesn't think about your taxes and your CPA doesn't think about your mortgage. The two of them never talk. So the gap sits there year after year, costing self-employed buyers tens of thousands in qualifying power they didn't know they were giving up. If you are self-employed, you have more options than your bank told you about. Conventional with 2-year averaging works if your numbers are clean. Bank statement loans and P&L loans bridge the gap when your tax returns don't reflect your real income. DSCR loans let you build a portfolio, and the year before you apply matters as much as the application itself. If you're in Southwest Washington, Oregon, or anywhere that I'm licensed, and you want to figure out which of these 4 products fits your situation, hit the link below to get on my calendar for a 15-minute call. We look at your actual numbers, we figure out which product makes sense, and if you're not buying for a year or 2, we plan backwards from there. Self-employed doesn't mean disqualified, it just means we document differently. I'll see you next time.